Welcome to The Explainer. Today, we're digging into something that is absolutely critical for anyone trying to build wealth, the 10 most common traps that catch new investors. We're going to break them down one by one and build a really powerful framework for long-term success, all based on our source material. All right, let's get into it. So, here's a really interesting idea from the source material. What if success in the market isn't some treasure hunt for the next big thing? What if it's actually about a disciplined, repeatable process of just sidestepping the common mistakes? It's about playing defense to win the long game. Okay, first things first. We have to start with the most important tool you have, and that's the thing sitting right between your ears, your own psychology. Seriously, before you even think about looking at a stock, you've got to get your own thinking straight. The first, and maybe the biggest, mistake is confusing a stock's price with its actual value. And this is driven by a funny little glitch in our brains called unit bias. It's that feeling, the one that makes buying 100 shares of $5 stock feel way better than buying half a share of a $1,000 stock, even if it's the exact same amount of money. But here's the thing. The per share price is totally arbitrary. It tells you absolutely nothing about whether a business is cheap or expensive. So the fix is all about a mental shift. You have to stop thinking like you're just trading a ticker symbol and start thinking like you're buying a piece of a real business, like an owner. The number you really need to care about is the market capitalization. That's the total price tag for the entire company. That's how you start to understand what it's truly worth.
All right, the second big mindset trap, chasing the headlines. This is fueled by this powerful cocktail of biases. And the biggest one, of course, is FOMO, the fear of missing out. You see a stock going vertical, everyone online is talking about it, and you feel this intense pressure to jump in before you miss out. Let's be clear, that is not a strategy. That's just a reaction.
And the fix for this is a simple, but honestly an incredibly powerful circuit breaker. The source material calls it the 72-hour rule. The next time you feel that FOMO, that urge to buy based on pure hype, just stop. Force yourself to wait 3 days. And in that time, ignore the news, ignore social media, and actually read the company's official 10K report. It's all about replacing that emotional gut reaction with some real analytical thought. Okay, so let's move on. Let's see how these errors in our thinking can lead directly to big structural mistakes in how we actually build, or, fail to build, our portfolios. A classic and really dangerous one, forgetting to diversify. This usually comes from overconfidence, right? That feeling that you found the sure thing. But putting all your eggs in one basket, while it might feel like a fast track to getting rich, but it means you're just one bad headline away from getting wiped out. So, no surprise, the fix is proper diversification. By spreading your money across different types of assets and different sectors, you're cushioning yourself from any single bad event. And this also involves something called disciplined position sizing, which really just means deciding before you buy how much of your portfolio you're willing to risk on any one idea. Now, for a really subtle mistake, but one that can eat away at your returns over time, ignoring share dilution. I want you to think of the company you own as a pie. Dilution is when the company keeps issuing more slices, which makes your individual slice smaller and smaller, even if the total pie is getting bigger. And here's how this little magic trick often works. You'll see a headline. Company announces huge share buyback. And that sounds great, right? But then you dig into the official filings and you see they're actually issuing even more new stock to executives. So if they're issuing more shares than they're buying back, your ownership stake is actually shrinking. The only way to know the real story is to check the statement of cash flows. Okay, so your mindset is getting stronger, your portfolio structure is sound. Now let's dive into the analytical mistakes that can still trip you up when you're looking at a specific company.
A really critical error is focusing only on net income, or earnings per share. It's what we're all taught to look at first. But because of accounting rules, the reported profit can be wildly different from the actual cash a business is bringing in. There's a saying for a reason. GAAP earnings are an opinion, but free cash flow is a fact.
So the fix is pretty simple. You always have to check the cash. You need to learn how to walk from that net income number all the way to free cash flow, because that is the real cash left over for the owners after everything is paid for. It's the true source of a company's value. Another huge mistake in analysis is using a one-size-fits-all approach. You just can't judge a software company using the same numbers you'd use for a bank. Every single industry has its own economic engine,
And you have to know which key performance indicators, the KPIs, actually matter for that specific business. You got to know the rules of the game you're playing.
So many people think that buying an S&P 500 index fund means you're evenly spread across 500 companies. But that's a really common misunderstanding. See, most big indexes are market cap weighted. That just means the biggest companies get the biggest slice of the pie. So your performance can end up depending on just a handful of giant stocks. Now, the alternative is something called an equal weight index. In this setup, every single company gets the same weighting, the same slice, no matter how big or small it is. Now, this isn't about one being better or worse, but they are fundamentally different. An equal weight fund gives you a completely different risk profile, and just understanding that difference is key. All right, we've covered mindset, we've covered portfolio building, and we've covered analysis. This last piece of the puzzle is all about mastering the actual process, the execution, and maybe most importantly, the learning. A classic rookie error is just fumbling the trade itself. You have to understand the bid-ask spread. Think of it like a hidden tax you pay to the market every time you trade. To control your costs, especially with smaller stocks that don't trade as often, you should almost always use limit orders instead of market orders. That way, you set the exact price you're willing to pay. Overlooking fees. This is one of the most destructive, silent killers of wealth. A 1% fee, it just doesn't sound like much, does it? But the impact over 30 years is absolutely devastating. That corrosive power of lost compounding means that tiny difference can eat up over 20% of your potential returns. Minimizing your costs is one of the only guaranteed ways to improve your results. But the most critical error of all is simply failing to learn from your mistakes. And the best way to fix this is to do a structured postmortem on every single investment you sell, whether you made money or lost money. By forcing yourself to answer these questions, you learn to separate your decision-making process from the outcome, and that is how you stop making the same mistakes over and over again. So when you put it all together, what's the point? The point is that by systematically avoiding these 10 mistakes, you fundamentally change your entire approach. You literally transform yourself from a hopeful treasure hunter into a disciplined operator. It's not about being some kind of genius who's right every single time. It's about having a solid, robust framework that manages risk, controls your own behavior, and actually learns from every single outcome, good or bad. So we've laid out the map to help you navigate around the most common traps in investing. By focusing on a sound process, instead of just chasing short-term results, you build the foundation for real, durable, long-term performance. The framework is right here. The real work starts now.